Hey guys, Mike here. This is Sharp Investing, and the disclaimer is don't invest on YouTube videos. That's crazy and not smart. All right, I'm going to talk about StoneCo. Update here after quarter three. There's not a huge amount to discuss, but I thought it was quite a good quarter. So I'll get into that. And I just wanted to quickly go over the thesis here. The thesis is, well, if you haven't seen the original video, then you should maybe watch that if you're interested. But basically the thesis in a nutshell is that in Brazil, the merchant sector and a lot of individuals were underserved by banks for a long time. And then the government deregulated and allowed all these fintech companies in. And basically there's this huge untapped addressable market there. And right now it's basically a land grab for companies like StoneCo, PagSeguro, Nubank, and Mercado Libre, who I think are all great companies actually as well. But there is a lot of open land for them to grab, and you can tell by the growth rates of all those companies. Like this last quarter, Stone put up 72% year-over-year revenue growth. So the things that they're doing as part of my thesis are they're creating a merchant ecosystem with a whole bunch of different software and services and products for merchants, so they can basically meet all their needs through StoneCo, or most of them anyway, and all the products work well together, and they don't need a tech person to try and integrate different software pieces from different companies and stuff like that. So the idea is that if they create this really strong ecosystem that's easy to use, the merchants will stick with them, and that allows them a bit of pricing power as well. And then on this company specific side, financially, like they were over 30% margin previous when they had their credit products up and running. They've paused that for a year and a half now, and so the margins aren't nearly where they were. Last quarter was 8.4%, but I expect them to get back up to the 30% range as the credit product starts getting back online in 2023, and the operating margins really take hold here as they grow. They have massive operating margins, which I'll show a little bit later in the video. And basically the idea is there's very few companies that I've seen that can do high growth rate and high margins at the same time. Usually companies have to pick one or two. So that's why I say they're in this club called the 30-30 Club, where they're capable of getting 30% margins and a 30% growth rate at the same time. So if you know more of those kind of companies, then send me a note in the comments and I'll look into it. Okay, so the results for the quarter three, were actually quite good. I was very happy with them. Revenue came in kind of where I was expecting, at 2.5 billion. The guidance was 2.4 billion, but they always guide low, so this was an expected beat. But the profit before tax, their pre-tax profit was 211 million, and that's up 100% from last quarter. That's quarter over quarter. So you can see that the margins are increasing extremely quickly now, and I expect that to keep up. So the margins went from 5.3% in quarter two to 8.4% this quarter. So you can see the path back to 30% margins is starting to materialize. They have guided at, what were they guiding at? 2.6 billion revenue next quarter and 250 million in pre-tax profit. Now, I expect that they're going to beat again. And so if we get 2.7 billion in revenue and 300 million in pre-tax profit, then you're actually up to an 11% pre-tax margin. So they're adding, kind of in the range of 3% to their margins quarter over quarter. And, another really positive thing is that Tiago, the CEO, he said that he expects these margin improvements to accelerate in 2023, right? So that was one of the things that I took from the call that I was very happy about. So, so the operating leverage here is really starting to pay off. I was talking about that in the last video, so if you haven't seen that, then check that out. But I will go into the cost side here shortly. Well, I guess let's look at costs now. StoneCo doesn't have a huge amount of costs associated with their growth. Their gross margins are very high, and if we break down some of their cost structure, I can show you the margins that they're getting on growth here. So if we look at cost of service, admin, and selling, these have gone up 114 million in the quarter, and that's versus 204 million in revenue growth. So that's a 44% margin that they're making on their revenue growth, which is very high, but actually down from the previous quarter. I think this quarter might be just an anomaly with some seasonal moving parts. If we look at year over year, these costs are only up 280 million, and that's on over a billion in revenue growth. So that the cost base there is only 27% of their growth, which, that's a 73% margin, obviously. If we look at financial costs, now this is the one that's a bit that can be not variable, but it's changed a lot in the last year, and a lot of that has to do with the rise in interest rates in Brazil, because StoneCo will have to borrow money in order to lend it out to their merchants. And we can see in this quarter, the financial costs actually didn't go up for the first time in a while. And that is, I think, down to two things. One is that the interest rates in Brazil have stopped rising, which is a big development, actually, I think. And on the other side, they have higher banking deposits, which means they can use that money to lend out to the merchants as opposed to borrowing it. So that reduces their relative cost as well on the financial side. Now, if we look forward a little bit, if we look at interest rates and inflation in Brazil, now inflation is below 7%. And so that means that the central bank may not need to keep their interest rates at 13.75. That's a huge gap. Usually central banks will try and keep 1 or 2% gap between inflation and interest rates in order. Well, that's the theory anyway. In order to bring down inflation. Now, inflation is coming down very quickly, and I think if it doesn't spike for whatever reason, interest rates will follow as well. Now we'll keep an eye on that. I don't really necessarily believe what the central banks say. I just wait to see what they do. So we will see if these come down. But if they do, then that's going to further increase the margins, because these financial expenses will start coming down, and they'll come down significantly too if those rates come down significantly. And sort of maybe a related item is that Lula has won the election, and from the little bit I was reading before, he is said to have inspired a credit-fueled boom in Brazil last time he was in charge. So we can maybe look to see what kind of policies he implements going forward. Maybe this is another tailwind, but I'm not going to bank on that. I'm just going to keep an eye on where that goes. Okay, and if I look forward a little bit, here's just a rough sketch on what I think 2023 might look like. I'm being pretty conservative in these numbers versus what I think is going to happen, but I just wanted to see what it looks like in a conservative scenario. So what this is doing is basically saying if they get a 40% margin on any growth they have next year, plus they get a 25% growth rate in revenue generally, then that's going to lead to a potential of 1,658 million, so 1.6.5 billion in pre-tax profit, which would put the margin close to 14%. And if we got a 10 multiple on that, the market cap would be 2.7 billion, and that's assuming a 6 exchange rate of 6. But if I don't know, a 10 multiple is pretty low for a high growth company, so I don't think that's a reasonable multiple. But if we got a 20 multiple on those earnings, then that puts it at about 5.5 billion US. And if we get a 30 multiple on that, that would be an 8.3 billion market cap at the end of next year. Now, again, I think the growth margin here, the variable margin on growth is going to be, I think it's possibly north of 50%. It could even be a lot higher than that. Just depends how they execute next year, but I think 40% is pretty safe. So what else do I want to talk about? There wasn't a huge amount to talk about with these earnings, but I guess recently the CEO position has turned over. So Tiago is moving on to the board, and we got the new guy going to start in before March. They said for sure. They didn't give an exact date, but I think this is actually good. It doesn't look to me like Tiago's quitting. It looks to me, just optically, it looks like he's either stepping aside or being pushed aside for somebody who's potentially better. Now, I looked at I forget his name. I'm sorry, I should have his name handy, but I looked at his history very quickly, and he's he seems very Wall Street friendly. He thinks about a lot of the same stuff that we think about return on capital and such. So that looks like it might turn out to be a fairly strong move. But yeah, I don't think that Tiago is necessarily quitting here for his own reasons. Like otherwise, I would expect him to quit and go find another job somewhere else. But instead, he's moving on to the board. They were a bit more in terms of credit. So this is the other potential upside here. So my example there for 2023, that doesn't include anything for credit. It doesn't include anything for credit. It doesn't include anything on interest rate changes, right? So these are two potential huge bits of upside that are available next year if things go well. So they are still being a bit, they're still being a little bit vague about credit and what their plan is, but it's starting to firm up, and they're saying that the 2023 they're definitely going to get going. It looks like they're going to be done their testing phase at some point and starting to ramp up. So assuming that has similar margins to what they had previously, the profit margin could come in quite a bit higher than the 14% that I'm estimating here. But anyway, I'm going to leave that as upside. I'm not going to bank on that. That'll just be a bonus if that happens. I'm looking at my base case here with just the current business, and I still think it's a great deal, even with the current business, without the interest rate change and without the potential for credit. I think that's it. I did want to get this video out. I'm going on holidays here for a week, and yeah, I just wanted to make sure I got this out. But if you're still with me, thanks for watching, and I will see you in the next video.